I wanted to kind of start off and provide a little bit of a platform for where we are nationally and kind of domestically and how the global nature of the economy is kind of affecting the overall sentiment of the market, not just here in New York, but across the country. And when we look kind of at the global view of what's happening in the world, there's so many things that are affecting our environment right now. You know, the main one, of course, is what we pick up every day in the Wall Street Journal is the European debt crisis. And the fact that Europe is in a recessionary environment, contracting by about 1.5% in the fourth quarter, and that there are certain economies in Greece and Portugal and Spain and Italy that are contracting by much more than that. We see a social unrest environment in the Middle East, which is not helping matters. Domestically, we have a political situation which, coming from Washington, I can definitely define as toxic, where nothing is really getting done in Washington, and it's affecting the overall economy from a couple different factors here in New York. One is the uncertain regulatory environment, and one thing up here that you'll see, Dodd-Frank and the question marks. Big banks right now are somewhat uncertain about the future landscape of the overall market and economy here right now because the regulators in Washington haven't been able to implement anything and haven't really been able to say we're going to keep this or we're going to get rid of this. And that has truly provided a uncertainty in the marketplace. And I don't like to start with this, but in the middle of the slide here, you'll see confidence. And I'm not talking about consumer confidence. I'm more talking about the confidence of businesses, corporates, and tenants in the overall marketplace. And what we've seen really over the past 9 to 12 months is a pullback in confidence levels from that corporate sector. With the problems in Europe, with the problems and I'd say the reset of growth expectations in some of the emerging markets in Asia and Latin America, and with our own domestic debt and deficit issues, we're kind of resetting our growth expectations for the next couple of years. But really kind of what it all goes back to when we talk about office demand and office fundamentals is employment. And actually, can you guys dim the lights here a little bit in the front if possible, so we can see this a little bit clearer? The key thing here, I know this is such an overused slide, but this line right here represents the current recession and overall recovery. And you can see the depth and the length of this recession is so much deeper than it's been in the past 4 to 5 cycles. It's in most cycles we were back to normal or back to peak levels within 36, 38, at max 42 months. We're 54 months into this cycle where we're essentially have not recovered and not even come close to the level where we were supposed to be or where we were at in 2007. And so, the big numbers out there, back to office jobs and back to overall demand in the marketplace, 8.7 million jobs were lost during the recession. To date, only 2.7 million have been recovered. Even with the most, I'd say, optimistic forecasts out there in the marketplace, we're expecting 2.2 million jobs per year in 2012, maybe a little bit higher in 2013. It's going to take us another 3 years to get back to where we were in the middle of 2007, early 2007. And that is a little bit of, I'd say, a disheartening statement. It's also, I'd say, a sign of where we are from more of a global economy and how we function today. Part of it's productivity. Part of it's the shift into the digital world where not as many jobs are required because productivity rates are heightened. And so this is not just, I'd say, a structural change in the overall recovery, but it's a fundamental change in terms of how we work and how efficient and how productive the workforce has essentially become. The good news, and I'm going to get to some good news, don't worry, is from the office sector job standpoint, professional and business services. It comprises the vast majority of office jobs around the country. It's the law firms, the PR firms, the marketing firms, accounting firms, consulting firms, et cetera. That sector only lost 1.7 million jobs during the past cycle. And to date, over the past 2.5 years, that recovery has been a little bit stronger for sure. We've already gained back about 1 million of those jobs. So we're at a much better pace from the office sector standpoint than we are from the overall macroeconomic standpoint in the United States. If you look at the current situation today and forecasted levels for 2012 and 13, we're growing at about 2% more or less in the professional and business services and other office-using leading industries. In the overall sector, we're growing about 1.5%. So we're still heightened in it, I'd say 25 to 30% more growth in the office sector than there is in the overall macroeconomic environment. And so, we go into this slide, which we use at Jones Lang LaSalle to kind of describe where markets sit in a given cycle. And the right-hand side of the clock is essentially markets that still benefit tenants. The left-hand side of the clock is markets that are still, I'd say, shifted to benefit landlords over the past 6, 9, 12 months. And the common thread among all the markets on the left, and you can't probably see that well, but it's San Francisco, it's Silicon Valley, it's Houston, it's Dallas, it's Austin, it's Denver, it's Pittsburgh, it's Manhattan, and it's Boston. It's essentially markets that are heavily dominated by two sectors, technology and the commodity sector. And the growth in those two sectors has been, I'd say, explosive, and that's an understatement, over the past 6 to 9 months. And the growth shows no signs of really curtailing over the next 12 to 24 months. But overall in the office sector, we remain very segmented from a recovery standpoint. Those office sectors are the anomaly, whereas the majority of office markets, whether you're in the industrial Midwest, whether you're in the Southeast United States, are still, again, a long ways back from where they were in 2007. And from a rent standpoint, need to get about 20% more rent growth in order to kind of get back where they were. And from a demand standpoint, are finally catching their legs and starting to feel some momentum in the overall demand standpoint. So, the market is highly segmented, as I just referred to. But how segmented is it? Well, across the absorption gains in 2011, you can see this big bar right here represents kind of Class A and trophy net absorption. If you look at the top 5 to 7% of the marketplace, what we consider trophy, essentially 20% of the occupancy gains in 2011 were driven by that sector. Flight to efficiency and flight to quality has definitely come back in a significant way in 2011 and into 2012, where you can see the B and C sector is still pretty stagnant at best. The industry sectors, I'm going to highlight this again. The tech and energy is explosive right now. And tech was kind of the darling of 2011, growing at rates of 3 to 4%. It's now up to about 5% if you look at employment levels. If you go to markets like San Francisco, if you go to markets like Seattle or Bellevue or even Austin, smaller tech segments, the feeling and the exuberance in those markets right now is almost absurd. It's back to kind of the 2000 levels, where the tech boom is just completely driving these markets forward. Markets like San Francisco, which in South of Market you've seen rents grow by 35%. In Palo Alto, you've seen rents go by 40%. The darling of 2012 and 13, I would say, is going to be energy. And what's driving the energy sector right now is a couple different segments. One, it's natural gas. Natural gas is the king of essentially the energy sector right now in the domestic economy. And what's driving that is the shale gas reserves. So all of your essential centralized economies from Texas to Colorado, Wyoming, the Dakotas, even Ohio and Pennsylvania are being driven by this explosive energy and I'd say natural gas growth. 14 to 15% growth in employment levels over the past couple months in the mining and energy sectors. 14 to 15%, 15 times essentially what we're seeing nationally on the economic recovery. Just back to tech in a little bit, and the title here says the E actually is present this time. Price to earnings ratio. There wasn't earnings in 2001. So many people ask about essentially, is tech the next bubble and when's it coming? Well, if you look at the Facebooks of the world, if you look at the Googles of the world, the LinkedIn, the Amazons, the Apples, the earnings and the profit margin those companies are amassing is pretty stellar right now. And if you look at tech strength versus stock values are somewhat undervalued. I mean, with the exception probably of Apple. You look at the rest of them, and it's somewhat of an environment that we saw not in 2000, but mainly in kind of 1998. So the overvaluation that a lot are saying, are there companies that are overvalued? Absolutely. But the overall sector, if you think about it, how we act, how we work, how we live, how we operate in our daily lives, it's moved to the digital world. And companies like Facebook and Google and Amazon are taking advantage of that and are the new kind of growth sectors of the economy for the United States and globally. So the key shift as we shift kind of into New York a little bit, again, hard to see on the screen here, but this right here represents about 85%, 2010. That's 15 million square feet more so. That 85% was dominated by Washington and dominated by New York. They accounted for all the occupancy growth in 2010, essentially, across the marketplace. That has shifted tremendously over the past 12 to 18 months, where those markets have become somewhat, I'd say from an occupancy growth standpoint at least, irrelevant to the recovery, where they go from 85% growth to 8% growth. And where we started to really see the shift was in the late spring and summer of this past year. As the Eurozone debt crisis escalated, as we saw our own domestic and deficit issues come to a heat here in the United States without any resolution to solve them, we saw demand levels from both the leasing and investment side kind of fall off a little bit. We saw rents stagnate, and we even saw concessions come up a little bit. And so you look at the overall economy and what's it being dominated by. 50% of it's being dominated by 15% of the markets, and those markets, again, are those tech and energy markets. And just to kind of clarify, overall, the overall U.S. office sector saw about 1% growth. That's below average, but still, I'd say a good point for where we need to be at this point in the recovery. You look at the 4 largest economies across the United States: New York, D.C., Chicago, and L.A. Chicago and L.A. never have entered this recovery. They've been a stagnant marketplace really over the past. They finally have stopped contracting and now are kind of in a stagnant mode. So they're not really growing at any significant rate at all. In Washington and New York, if you look at an employment growth standpoint, if you look at economic growth standpoint, and you look at office growth standpoint, have kind of moved into that stagnant territory. A couple, I'd say, things to watch out for as we enter 2012. One of them that we foresee kind of changing pretty quickly is the Sun Belt markets. We all kind of read and heard about how the markets in Arizona and Nevada and Southern California and Florida would take a long time to recover, and that they're not even close to the bottom. Well, we've seen a fundamental shift in those markets over the past 3, 4, 5 months, and it's pretty substantial, I'd say, in those segments of the market. You've seen markets like Orange County and Tampa and Miami and West Palm Beach go from substantial contraction to substantial expansion. Part of it is that these markets have diversified. So markets like Orange County have taken advantage of the technology boom and kind of the gaming boom out west. Markets like Tampa have taken advantage of kind of the increased importance of healthcare and call center and back office financial operations. Markets like Miami have essentially positioned themselves as the gateway to Latin America. And you see these markets not growing at 1%, not growing at 1.5% or 2%. These markets now are growing from an employment standpoint and some economic growth standpoints at 4 to 5% over the past 6 months. And it's not something that we've seen, these markets are at absolute bottom, but we believe they're going to be at bottom over the next 3 to 6 months, and that they're going to outpace the national recovery as we head into the end of 2012. Last 2 slides, and I'm going to kick it off to our panel to talk more in depth about New York. But the caveat here, I'd say, for New York and for the overall domestic market is that we have such a limited construction pipeline. And if you look at any other cycle that we've essentially come out of over the past 35 years, there was always a substantial development pipeline to fill up as we were kind of treading through the recessionary waters. This time around, if you eliminate kind of the downtown Manhattan projects and you eliminate a project that was funded by the Middle East and Washington, D.C., and a biotechnology build-to-suit in Boston, essentially you're at no development activity. So you're going to be in 2014 and 2015 with essentially no new product delivering. And in marketplaces, especially core urbanized marketplaces with transit-oriented development and a high amenity base, large block options are already limited. And so you're already seeing a shift in rents. Asking rents are up, taking rents are up, concessions are down slightly. We have 3 years essentially to recover in that sector, and those sectors are much more tighter than the overall economy. And so you could see, and I know this is a hard thing to grasp right now, rent spikes in a lot of these CBDs and urban marketplaces in the 2014, 2015 timeframe as no new construction is in that marketplace. And I'd say that the last thing I think that's really essential to New York, and really essential, I'd say, to the other urban marketplaces around the country, is the understatement. We can't underestimate enough the power of demographics. And the Generation Y age group, or however you want to kind of determine it, is fundamentally different, how they act, how they work, and where they want to live and where they want to essentially work. And what we've seen is, in recent surveys, 75 to 77% of Generation Y wants to live and work in an urban environment with rich amenities, transit-oriented development, and kind of a fast-paced lifestyle. That benefits, markets like Manhattan. It benefits markets like Washington and San Francisco and Chicago and LA. And this is not changing. We saw the kind of the flight to the suburbs in the 90s, in the mid-90s. Now we're seeing over the past 4 to 5 years definitely a shift back to the CBDs and to the urban marketplaces becoming kind of king again and dominating the fabric of where people want to do business and where people want to work.